So as we already discussed, monopoly with a single price monopolist, and now we will see that how the cartels going to work. So cartels and monopoly powers. So as monopoly is going to give some power for the firms to make more profit. So in that scenario, as I mentioned, the cartels are formed in order to make more profit, enjoying the monopoly power. And we see here that the monopolies are producing less and charging high price as compared to a competition. So cartels tend to unstable because members have an incentive to cheat. Now, why the cartels are not successful? We see that here we're going to talk about that why the cartels are not successful or successful completely like a monopoly. The reason is that when more than one firms are operating under the agreement of a cartel and they keep the quantity low in order to charge more price. So at some stage, maybe some of the member or one of the member think that if I produce more and the prices are very high, so I can make more money. And this incentive creates instability in the cartel because anyone at any time can cheat and produce more. And with this more production, what is going to happen? The price will go down. So there is two possibilities. Either the one who cheated is going to go back again to his commitment and cooperate again and to form a cartel or keep the cartel going. The other possibility is that the other members of the cartel can be reactive and they say, okay, if you produce more, we will produce more, and by this will the prices go down. So we can see that this incentive to cheat in this cartel type of organization or arrangement is make them cartel unstable. So we see here output thousands of unit in our left-hand panel. The demand curve and the minor revenue curve, and the minor revenue curve and minor cost curve determines how much and the quantity they're going to produce, and by this way the price is very high. With this price, the cartel is enjoying a monopoly or with the economic profit. So we see here there's a huge economic profit, and there's always incentive that they can produce more, and by this way they can a cartel member's incentive to cheat is greater. The price is greater than marginal cost, so they can cheat. So any one firm within the cartel has an incentive to cheat, but if all firms cheat, the price falls back towards the competitive level and joint profits will not be maximized. So a successful cartel must also be able to prevent the entry of new producers. A successful cartels are often able to license the firms in the industry and to control the entry by restricting the number of licenses. So that's a way that they control the cartel by keep restrictions on the entries. And we observe this in many practical examples of a day. Like in New York, the cab licenses are very limited, and after the introduction, and that's again very a superb example of a destructive creative destruction with the invention of these Uber and Lyft. Now these monopolies of taxi drivers in big cities like New York is eliminated, and they keep the license numbers plates of our taxis very restricted for a very long time, and for that reason the value of their license plates are very high. So this is the we want to discuss how they make cartels, how there is a failures of cartels to keep the prices like a monopoly prices. And now we're going to talk about price discrimination. So price discrimination means that we are selling the same product at two different prices. So is a sale by one firm of a different units of product at two or more different prices for reasons not associated with the difference in cost. So the cost of the production of those two products are very same, but they are selling at a different prices. For example, a very common example, if you ride a bus here and I ride a bus, so what's going to happen? you're going to pay less, I'm going to pay more. The reason is that you have a student status and I have a adult status. So we have to pay. The cost is same for having one passenger on the bus, but they are charging different prices. If price differences reflect cost differences, they are not discriminatory. If there's a cost, like if you're traveling on an aeroplane, one is first class or business class, and the other one is economy. The cost of operation on those two classes are different because of the number of seats are less there on that cabin for first class. So the costs are different. So that's not a price discrimination that the airlines are charging high price for first class or business class as compared to economy class because the costs are different. But when they are charging different prices within the economy class, then it is a price discrimination because the cost is same. So that's a point we have to understand. If they are charging different prices within the first class, that's a price discrimination. So when price differences are based on different buyers' valuation of the same product, they are called discriminatory. Now, why is price discrimination possible? There are three conditions that make it possible to discriminate between the buyers. Market power, so that the monopolist has a control over the product. If the product is highly substitutable and a lot of substitutes are available, then the seller cannot create that monopoly power or a market power. Different valuations of the product, like everyone is valuing differently the product. For that reason, there is a possibility that we can sell at different. If everyone is valuing that product same, then product differentiation is not possible. And the third one, which is more important, is prevent arbitrage. That it is not possible for those products that you buy and you sell it to the others. Like if you are buying a ride for a student and you sell it to the non-student, then there is a possibility of an arbitrage. So technologically and practically, we make it impossible that arbitrage can be possible. And you see, as I give you an example, like in airlines, economy class, many passengers are paying very different prices. The reason is that when you buy a ticket, normally it is not possible that you can change the name of the passenger for a ticket. So that's one way of preventing arbitrage. Different forms of price discrimination. Now, price discrimination is also different forms. One, price discrimination among units of output, like a firm captures consumer surplus by charging different prices for different units sold. Price discrimination among market segments, easier for a firm to distinguish between different market segments. That is, like I gave you an example of like in the first case, the example is airlines charging different prices. In the second case, the example is like a student or a senior citizen or a normal adult and the youngs. So that's a discrimination on the basis of the segments of the market we create. So price discrimination among market segment is more common than price discrimination among units. In this case, also we see if you buy insurance for your car, you have to pay different prices. The reason is based on your record, your own record. So that's a price discrimination out of unit of output. If you buy health insurance, again, it's based on our health record. So these are the things that is possible for a unit of output, price discrimination among unit of output, and price discrimination among the segments. So when a price discrimination among unit of output, in this case, what is going to happen? The consumer has no surplus. Consumer is paying the price of what he is willing to pay. There is no surplus. All the surplus goes to the seller. So that's what we call we see here that they are charging P1 for the customer who is willing to pay this, and P2 for the customer who is willing to pay it, and P3. So the consumer surplus is 0 in that case, and the producer surplus is large. Now, here we can understand this idea of a price discrimination in a practical way. Like there are two markets, and the markets we are selling tickets. So markets we are selling tickets, but these are two separate segmented markets. We can say it's a student or adults, or we can say that it's a young and adults or a senior citizen adult. So whatever, but there are two different markets, and both the markets have a different demand curves. So this one is a demand curve for segment A, and this one is a demand curve for segment B. And by this way, we have a different demand equations, and the marginal cost is same because the product is of the same. That's why we are saying that we are talking about price discrimination. So if we are charging a single price for the customers, like here we see that the minor. So we are saying here that we are charging $11 for both the markets. $11 for both the markets. Now with the $11 for both the markets, so with the 11, if we sell 11 in this market, so you can charge $26 price around this, like around this. So we charge $26 price, we generate 286 total revenue. Total cost is 4 into 26 is 104, and by this way we have a profit of 182. And similarly, in the other market in which we charge $11, so we are able to sell around 30 tickets, and by this way we have a revenue of 330. Total cost is 320, 4 into 30, 120, and the profit is 210, and 210 plus 182 is 392. So that's the total profit by charging single price. But if they are able to discriminate between these two market segments, so what they are doing, they are determining, okay, in this case we sell 20, and for 20 we can charge in this market, if we sell 14, if we charge $14, and by this way we can sell 20 because we have a different market. So we see here this point, it's a 20 quantity and 14 price. So we can generate 200 revenue, 200 profit, 280 revenue and 80 cost and 200 profit. And if we charge $10 price in this, we are able to sell 36, and we see 360 is the revenue, and 144 is the cost, and 216 is the profit. And when we combine these profit, we have a 416. So in single price charging, the profit is 392. And when we charge different prices, because the markets are different demand curves, so we are going to earn 416 profit. Now there's different forms of price discrimination. There is some ways of creating a hurdle pricing as well. Hurdle pricing exists when firms create an obstacle that consumer must overcome to get a lower price. Consumers then assign themselves to the various market segments. Those who do not want to jump the hurdle and are willing to pay the high price, and those who jump to the hurdle to benefit from the low price. A familiar example is a coupon for discounts at grocery stores or Costco. In Costco, if you are a member, you are able to buy. If you are not a member, you are not able to buy. So this is an example of a hurdle price. For any given level of output, the most profitable system of discriminatory prices will always provide higher profit to the firm than the profit maximizing single price. A monopolist that price discriminate among units will produce more output than will a single price monopolist. So monopolist is going to produce more, and in case of a price discrimination. If price discrimination leads the firm to increase total output, the total economic surplus generated in the market will increase, and the outcome will be more efficient. So that's a price discrimination is more productive, is a less deadweight loss as compared to when we are having a single price monopolist. So this is all what we want to discuss for monopoly, cartels, and price discrimination. So it's a second form of market in which we discuss a very extreme case of a single seller, and we will see that single seller with a single price or with the price discrimination, charging various prices for various customers. So I hope you enjoyed. Please don't forget to share as well as subscribe. Thank you.